Okay, look, I think at a headline level, whilst the interest rates where they are, and with an expectation that they're going to go lower, and the 10-year rate being not terribly much higher, people are going to be attracted to the fully franked dividend offered by the share market. If we think about the banks, yep, they face headwinds, but you're in a relatively benign bad and doubtful debt cycle at the moment. Not that we're big fans of them, but they're a lot better value than they were perhaps 4 or 5 months ago. If we think about globally exposed industrials, we think there's still some value there, and particularly if China plays out in some of the way we expect, then the Australian dollar will go lower, almost without doubt. Some of those corporates, we're also focusing on corporates that actually are investing for the future. So an example there would be Brambles, another one would be Incitec. You're seeing Amcor continuing to do it. Companies that are actually reinvesting to grow their business, even at this point in the cycle, to us attractive, because they will keep that growth coming through in the years to come. There are also segments, obviously the Australian economy, that are going to do well out of the lower rate environment and pressure coming off resources. The education sector, to the extent you can play it through the market. Tourism's obviously attractive, although a number of those positions are now getting quite, some of that upside is certainly reflected in their valuations. One that I do like at the moment is Echo Entertainment. Echo's obviously runs the Star Casino here in Sydney and the Gold Coast Casino, and it's just won the rights to expand its Brisbane casino. One of the things that we actually like the Echo story purely around domestic gaming growth. In terms of other ones, we like Village Roadshow, which has some exposure to the tourism dollar through its theme parks. Look, that has had a very strong run since reporting. It is benefiting from a very strong film slate this year, but earnings earlier this year were weather impacted parks, so there might be a bit more in that. And the other one we like is Ardent Leisure, where a small part of their earnings actually comes from the theme parks again in Queensland, albeit the main reason we're there is actually the growth in the main event business in the US. It is entertainment based there. It's an $A beneficiary to an extent if that continues to come off, albeit we don't need to be there for the currency. We think the underlying growth stories enough.